Hey, in this video, I'm going to do a review of Disney. Disney was a stock that was hit pretty bad about 2 years ago when COVID first hit in March of 2020. The stock pretty much did nosedive, but it did recover a little bit. It went flat for a little while. And now I do have some good news for those shareholders of you out there, because some really good news recently came up with the stock. Actually, a few good things happened. So we're going to dive into that in a moment. First off, with Tykr, we teach investors to not only look at the numbers, but look past the numbers and look at the business. A lot of investors, they like going to different sites and screeners, and they'll look at something and then they'll make a decision. Well, what we do is we're big on not just looking at those numbers, but understanding everything you need to about the business before you make a buying or selling decision. This really relates to the teachings of my mentor, Phil Town, and of course, Warren Buffett, Charlie Munger, and Ben Graham. Real quick, we like to focus on the 4 M's. The 4 M's include the margin of safety, which is the math part of investing. And then you have the meaning, moat, and management. The meaning is the business model, how they make money, where the business is going in the next 10 years. Then you have the moat, which is the competitive advantage. And then you have the management, which is that's a CEO. What kind of business experience do they have? What kind of track record of building businesses? And of course, increasing share prices. So we're going to kind of go over a little bit of each within this video to give you a better idea of what's happening with Disney. So let's get started. You got the summary. What we do right now is we classify a stock as either on sale, watch, or overpriced. On sale is green, overpriced is red. Then we have a score from 0 to 20. Higher the score, the safer the investment. In other words, the stronger the financials. And then you have the margin of safety. In this case, you can see here we've got a 1%. So overall, Disney does not look great with that margin of safety. Just to define what that means real quick, that's the discount, the share price discount off the sticker price, or otherwise known as the fair value or intrinsic value. Long story short, when you're buying stocks for the share price, that's not what it's valued at. There's a real value behind that, which is called that sticker price or fair value. In simple terms, I like to phrase it as, let's say you're going to the grocery store, you find a gallon of milk for $5 and you can buy it for $2.50. That's great. You're buying something at a discount. Warren Buffett has said it's like buying $10 bills for $5, is you want to buy stocks that are on sale. So, and a great example would be, let's say you see a stock that's got a share price of 100, but a sticker price or fair value of 200, that's a 50% margin of safety. In other words, that share price is 50% off. So when you look at the actual numbers of Disney, this can scare a lot of investors because they'll see the red and they want to avoid it. But we're going to look past these numbers here and look at the business, because this is where things get interesting. So in most cases, if I'm investing in a stock, I like on sale stocks. That's really where I start, and I'll continue my analysis if they're all green. But in this case, because Disney's a big brand, there's some special things going on behind the scenes with this stock, and we're going to dive into that real quick here. So I did a review this last week. I try to do a written review once a week. I'm not going to go over every detail, but here's some of the news related to Disney over the last week or two. Recent earnings report came out. Every quarterly report that comes out with a stock is really important, because that's where the fundamentals are updated, and that's what causes the changes within Tykr. In this case, EPS, earnings per share, this is one of the most important metrics of any business. This is really the profitability of a business. It was expected to report at 63 cents. They came in at $1.06, which is a massive increase. That's awesome. That's a really good sign. Revenue was expected to be about $20.9 billion. It came in at $21.8 billion, which is great. They beat expectations there. With Disney Plus subscriptions, they're expected to come in at 125 million subscribers. They actually came in at 129 million. So more good news there. Other good news you can see here includes the revenues for 2022. Q1 was expected to be, was reported at 7.2 billion. And if you go back a year, it was 3.6 billion. So another nice increase there. Things are starting to change. When you look at the business model, I want to talk about this a little bit. You have really four main revenue streams within this business. You've got the parks, experiences, products. This includes, of course, your theme parks, cruise lines, merchandise, resorts, royalties, these properties. Then you've got linear networks, which is essentially cable networking, TV stations that are affiliated with Disney. Then you got your direct to consumer. This is your Disney Plus. You've got ESPN Plus, and then Hulu. And then you also have licensing with, you've got film, TV, DVDs, Blu-ray, music, live entertainment. These three, the linear network, D2C, and then content sales and licensing, these were all sustaining well even through COVID. This was a really good sign, and those will continue to grow. With parks now opening up, and I heard on Motley Fool, actually, I was listening to a podcast this morning. They did say that parks are, especially in Orlando, I think they're not requiring masks, or they're going to not require them here in the near future. We know parks are starting to open up, cruise lines, resorts, everything. This is a big part of the revenue streams. These are opening. This is a great sign for investors. So just keep this in mind. Let's touch on the 4Ms, because this is really the most important part of any business. So right off the bat, we know the margin of safety. The math doesn't look great. These numbers, the ratings don't look great. So if you do hold this stock and you've been worried and thinking about selling it, I would probably still hold. Now, in this case, let's look past the numbers and look at the business. With the meaning, we know they've got those four revenue streams. Another thing I'll point out is they just, as of the recording of this video, it's March 4th, but on March 1st, they released their new theme park, which is the Star Wars Galactic Star Cruiser. And get this, it's $5,000 for 2 days, and a place has 100 rooms, it looks like. So essentially, if you do the math there, they are generating about $250,000 per night to stay at this place. And essentially, it's a giant building with no windows, but it simulates you being in space. And they've got a bunch of actors and actresses, and they really simulate a Star Wars theme. It sounds like if you really like getting in a character and are really creative, this can be a really fun experience, especially if you have some kids. You have to embrace the experience to get the full value out of it. I tell you what, I'm not ready to pay $5,000 for 2 nights in a resort like this. Not yet, at least. I love Star Wars, but I might just hold off for a little bit. But that's an impressive additional revenue stream to the business. And within this article, I did mention their expectations are they want to generate about $80 million per year on lodging alone on this new theme park. So pretty cool. Another good sign with Disney. When you take a look at the moat, I can tell you right off the bat, there is nothing that really compares to the theme parks. The nostalgia going back to when this company was created, back to 1923. So that's almost 100 years. There's a lot of nostalgia around this business. So the theme park experience is a big deal. There are a lot of theme parks around the world that are not Disney. They're probably fun, but nothing compares to Disney. So there's a wide moat there. People love the Disney experience. The issue is, and this is not a big issue, is the direct to consumer. ESPN is great. People will always subscribe to that, but Disney Plus has a lot of competition from platforms like Netflix, Amazon, HBO, and then you have the new ones like Paramount and Peacock. These may take subscribers away, but at the point, all these platforms are cheap enough so people own multiple. Like in my case, I have Disney, I've got Amazon, I've got Netflix, HBO. So I'm okay to pay for all, but if they keep expanding to too many different networks, I got to pick and choose. It's going to get a bit ridiculous. Now let's talk about management. It's important to look at the CEO because you can't just find somebody with a good attitude and the aspiration to do good things and they can get after it. It just doesn't work that way. You need somebody with real business experience, somebody who's really moved the needle, somebody who knows how to make quick decisions and make very few mistakes. Getting to that CEO position in a publicly traded company is very difficult. And it's good to see people who have a track record of increasing substantial revenue and, of course, increasing the share price in businesses. So you look at the manager right now, the CEO, you've got Bob Chapek. He's been the CEO since 2020, but he's been at Disney for 30 years. And this is something to pay close attention to. He served as a chairman of Disney Parks, Experiences, and Products. So that's great experience. That's that big revenue stream, part of the business. He was also part of distribution for Walt Disney Studios. What's important there is he understands when you think of distribution, in my case, coming from the world of tech, we can call it channel partners, is you want to find businesses and other streams or other partners that can get you out to a larger audience really fast. And with distribution, if you're really good at that, you can build businesses really fast. It's all about building relationships with like-minded businesses that kind of serve your same audience. You can get exposure to that audience. You can sell your products or your services to them. It's just that's how publicly traded businesses grow so quickly, is through these channel partners or distribution channels. So he's really good at that. And I was really pleased to see the combination of both. You've got the actual parks and you've got the distribution experience combined. That's a 1-2 punch. I think the board of directors knew exactly what they're doing when they put him in the leadership role, or at least gave him the nod of approval. So I'm really excited to see what he can do. I think with the CEO of Disney, they have to maintain that charm, that creativity that really makes Disney special from anything else. You can't get corporate-y. You can't create this really dry, boring company. You gotta maintain that charm, like I said before. So overall, when you look at the meaning, moat, and management, they're looking really good for this business. It's just that margin of safety, that first M is where some improvements can be made. So if you're an investor in Disney, I think times are about to change. You're going to see the share price go up. And then if you're interested in diversifying your portfolio, this might be a stock to take a look at. So just food for thought.